We're continuing our Chapter 17 video lecture, and we're now focused on the elements of a financial statement known as an income statement. So we've talked about the revenues, we've talked about the cost of goods sold, we've talked about the gross profit or gross margin. Next up, we have what's known as the operating expenses. Again, these will be called the cost of doing business. So expensive things such as rent, utilities, and salaries. There's something called depreciation that you'll learn a lot more about in your accounting course. But to give you a quick example of what this is, when you acquire long-term tangible assets such as buildings, machinery, automobile, over time the cost of those items will become an expense through a process known as depreciation. We typically have different categories of operating expenses. You will have selling expenses, which are a direct cost of selling a product, such as marketing, advertising, salesperson salary, and what we call general administrative expenses. Those are expenses and indirect cost of selling a product, such as salary for those who work at the office, insurance, rent, and other types of general expenses. Okay. So again, on your income statement, you're going to show whether or not you had a net profit, which means that you made money, or whether you lost money. So revenue minus your costs, expenses, and tax over a period of time will determine whether your bottom line was a profit or if you lost money. And think about it. Why do we go to business? We go into business to make money. Okay? So here we have Lonnie, who owns a gas station. Let's see. He worked with local suppliers to provide healthy organic foods. In 2007, he took out a loan for $875,000 to purchase the property and gas pumps from a BP. His business now brings in $11 million annually. The question is a good question. What is the difference between revenue and profit? Send me an email with the answer to that response. What's the difference between revenue and profit? The statement of cash flow is another type of financial statement. What this statement shows are our different cash activities, our cash receipts, cash coming in, our cash disbursement, which is cash going out. And they're broken down to three major type of activities: operations, investments, and financing. So in the statement of cash flow, it will show the cash receipts and cash disbursements from all three of these different types of activities. Okay? Now that's important because as a business, you need to know the difference between the cash that's coming in and the cash that's going out. So managing cash flow is a key consideration of if I'm going to do business with a certain company, if I want to invest with them, loan them money. So buying goods on credit can be a problem, meaning that if we do not have a good stream of cash flow coming in, we may not be able to acquire things on credit, or if you do get things on credit, may not be able to pay them in a timely fashion. Okay? Ratio analysis. Ratio analysis is the assessment of a firm's financial condition using calculations and interpretations of financial ratios developed from key components of the financial statement. Now, what does that mean? Well, with ratio analysis, we'll take certain information from the balance sheet or the income statement and break it down into smaller segments. And so what the ratios will focus on are liquidity, debt ratio, performance ratios, or activity ratios. So each of these ratios will tell us something about that business organization. I'll provide more detail about this. As a matter of fact, you have a course project coming up that will deal with some of these different types of financial ratios. But let's first talk about liquidity ratios. Liquidity focuses on a firm's ability to turn assets into cash to pay its short-term debt. So now we're saying, do we have the ability to take care of all of our obligations as those obligations are becoming due? So make it personal. Think about your bills upcoming for the next month, whether it's rent, card note, insurance, gross, etc. Think about your finances that you currently have or your money coming in for the next month. These ratios will show whether you have the ability to take care of those short-term obligations as those obligations are becoming due. Now, with the debt ratios, these are more long-term. These ratios are relied upon to determine if we should loan money to a bank, and if so, at what type of interest rate. Because before I loan you money, I need to make sure you have the ability to pay my money back, right? And so these type of ratios tell the bank if or not they feel safely loaning the company's money, and if so, what type of interest rate. Your debt ratios has a huge impact on the interest rate you're going to receive on the money that you borrow. Now, we have debt ratios broken down by industry. So whether it's retail, automotive, hospitality. And so when banks look at your ratios, you're compared to other companies in your industry to see if they feel like you're going to be a good investment. Other ratios focus on how profitable is a business organization. One such ratio is called earnings per share. Earnings per share. So remember, as a stockholder, you are part owner of that business organization, right? That's right. So what earnings per share shows, it shows if I own one share of stock in a company, what is my portion of the profits that was earned by that business? So these other ratios like return on sales, return on equity, again, they all focus on how profitable was that business organization. Activity ratios shows how effectively management is turning over inventory. So now we're saying that you're selling an actual product. This ratio focuses on how quickly you're able to turn over, which means to sell your inventory. Because that's important. Because the quicker I can sell my inventory, the quicker money comes into the actual business. And yes, we have ratios by different industries that shows what is the average inventory turnover time. Okay? Next, we have different accounts that you will see on a balance sheet. This first category shows different types of assets. Second category shows different types of liabilities. And the third group shows your different types of owner's equity. And again, as you take your applied accounting and financial accounting course, you'll learn more about these different terms. Next, these are terms normally shown on the income statement. These are different types of revenue. I'm selling a product. Here I'm renting out spaces. If I provide a service, it may be commission revenue. Next, you have your, cost of goods sold, the cost of buying or storing goods. And then you have your different types of operating expenses for wages or salaries, rent, insurance, etc. So these are some common account titles you're going to see on what's known as the income statement. Okay? So now, financial accounting. Accounting information and analysis prepared for people outside the organization. So if I was to ask you if the Apple company is successful, what would be your response? You probably would say yes. And then I would ask you, well, how do you know that they're successful? Well, what Apple does is prepare what's called an annual report, a yearly statement of the financial condition, progress, and expectations of an organization. So if you are a public corporation, meaning that you trade stock on a public stock exchange, you must prepare an annual report each year that provides information about your finances. The annual report, which we'll take a look at in a few minutes, these are the key elements. It will consist of management discussion and analysis, which is data coming from management about how well a company is performing. It will consist of statements such as the balance sheet, income statement, statement of cash flow. And then there's an outside accounting firm known as an auditor that would give their opinion about your information. In essence, we want to know, does the information shown on these statements reflect what actually took place for that company over a certain period of time? The auditor would tell us if the company followed the accounting principles when they prepare their financial information. Now, there are different types of accountants. You have private accountants, public accountants, and we'll talk about what it means to be a certified public accountant. When you are a private accountant, that means you work for a single firm. So you work for Tesla, you work for Google, Amazon as an accountant. With a public accountant, an accountant provides accounting services to individuals or businesses on a fee basis. So a lot of companies do not have their own accounting department. They outsource it to a public accountant. And that's an individual or a company that provides a variety of account services to the general public. A lot of public accountants have what we call a CPA license. That's an accountant who passes a series of examinations established by the AICPA, which is the American Institute of Certified Public Accountant. So pretty much as a CPA, you have a license, you have a credential that says that you are qualified to do certain type of work within the accounting profession. Now, there are some overseeing when it comes to the accounting profession. Because remember, the information prepared by these companies, whether it's again Tesla, Google, Amazon, whomever, people are making decisions based upon that information. So there's an act called the Sarbanes-Oxley Act that was passed in 2022 that created new government reporting standards for publicly traded companies. So again, if a company trades their stock on an open stock exchange market, they're known as a publicly traded company, and they have to meet some requirements set forth by the Peekaboo, if I call it Peekaboo, which is the Public Company Accounting Oversight Board. Okay? So pretty much it's to protect the public to make sure that when you are reviewing a company's financial information, that they have met certain restrictions, they have followed certain rules in preparing their information. There are other things such as the Consumer Protection Act, which is out there again to protect the public from fraudulent information. Now, as a CPA, we have to maintain our license through continuing education. We have to go through training. We have to continue what we call CPEs. You have to complete so many hours of training every year. Have to take an ethics training. And again, you must pass an ethics exam. Okay? So stay tuned for the exciting conclusion of our Chapter 17 video lecture. Bye bye.